thinking what could be more suitable. Yes, please give me the that tool. What could be more suitable after the investing part than to follow up with the numbers guy, who has a picture.
I got a picture. Thank you, Emily. And I'm really happy that Javier got all the tough questions. So it'd be good to me, okay? So my name's Michael. I've had the privilege of being the Chief Financial Officer here at Intrum for about 3 years. And I know it's been 3 hours, and all you've been waiting for is hearing about how all of this translates into the numbers. But please bear with me for another 1 or 2 minutes, because I think it's equally important to kind of go a little bit down memory lane and think about how we got to where we are today, because that's really going to contrast what we do going forward. So if I go to my first slide, how we got to where we are today, and for that I need to go back to the last Capital Markets Day in late 2020. And if I had to identify the sort of the key element of the story we talked about then, it would be to grow cash EBITDA. That was sort of the foundation of everything we talked about. So what did we do? So if we look at the chart on the left, we did grow cash EBITDA, we grew it by 16%. But when we then look at the building blocks that we laid out at the time, it's 3 of them, for those of you who followed us then, it was normalization, it was transformation, and it was business growth. It's equally important to analyze how we did do on those, right? Because that was really underpinning that trajectory. Well, normalization, or coming out of COVID, going back to where we used to be and maybe a little bit beyond, we didn't fully deliver on that, or that didn't fully happen. It happened in the south, but when we look at the other geographies, we had less inflows and we had some margin challenges. Now obviously the inflows have really turned around in the last 2 to 3 quarters, but that normalization didn't fully happen. When we look at transformation, second building block, important building block, well again, we did not fully deliver on that. We had some gains, limited gains, but they were very much overshadowed by increases in costs and overheads, also due to an overly complex operating model, which Andres has talked about and which we have already addressed. So we have the foundation going forward. And lastly, business growth. Well, I would call it patchy or uneven, but I think that sort of overshadows a little bit what the truth is, which is we grew the book value of our investments. So the business growth very much came from the capital heavy investing side of the business. And because we grew the book value of our investments by 17%, we also expanded our net debt and our leverage went up. So where does that leave us today? What's the foundation going forward? Because obviously we haven't delivered on everything we set out to do. Well, we have the largest servicing business in Europe, and we have a very large, valuable back book. And I think that's 2 elements that are very important in the story going forward. So what are the building blocks of the story going forward? It's profitable growth in servicing, focusing on that core servicing business that we have, that we want to further emphasize and build on. In investing, it's all about extracting value, and it's about a potential additional upside from the pivot to capital light. And then obviously that comes together in the balance sheet. And the story around the balance sheet is one of de-risking and deleveraging. What I've done on this page is bring a little bit together what you've heard from all the speakers today, what you've heard from Annette, what you've heard from George, and what you've heard from Javier. So if we look at our businesses and we start with servicing, in servicing we want to grow. We want to grow profitably. So that means we are client-centric, we work with our clients, we find new clients, we expand the relationship with existing clients, but we're also focused. We take down our geographic footprint to where we can really make a difference, where we have the right foundation. And that's our franchise markets essentially. And the drivers for that are really commercial focus, commercial excellence, and the value chain expansion that George has talked about. That's the growth element. Then there's a margin element. There's a tactical element to the margin, which is the cost program that we've talked about, that we're executing on. And there's a medium to longer term element that we're phasing in, which very much ties into the operational building and transformation and work and the use of technology that Annette has spoken about. Investing, very different story. Investing, it's really about taking that back book, extracting value from that back book, strictly limiting new investments, and having the upside potential from the pivot to capital light, from the asset management model. How does that come together into de-risking and deleveraging? Well, we're going to reduce the book value of our investments. We're going to use the cash flow. It's a highly cash generative business. You've heard me say this very often, but we're going to use that cash flow to very much address our debt. And then that gives us the opportunity, once we've delevered, to resume remunerating our shareholders as well by paying a dividend. So when I translate this into assumptions that underpin our financial trajectory, and again, going a little bit back to what George says, is really a story of growth and servicing. About half of it comes from Middle Europe, but all the areas contribute. In terms of the margin, the tactical short-term measure is really our cost program. It's a cost program, as we said in Q2, of more than 800 million SEK. We're executing on it, and most of that will be achieved on a run rate basis by the end of this year, and then come into the actual accounting numbers throughout the course of next year. On top of that, we have all the operational efficiency and technology journey measures that further underpin that margin trajectory and allow us to realize operating leverage and get bottom line out of the revenue growth that George has spoken about. On the investing side, we're planning to unwind our back book at equal or greater than the estimated remaining collections. And remember, we have a history of good overperformance. We're planning to limit new investments, so new investments from our own balance sheet, our own capital, to around about 2 billion SEK a year. And that's really reflective of volumes that are contractually locked in, or volumes that really are interlinked and support the servicing business. And we've assumed no upside from asset management in the financial trajectory that I'm going to get into. Now, in terms of accelerating the deleveraging, generating liquidity, we're also looking at selling some of the back book. And that can basically take two forms. On the one hand, and we've talked about this, we're looking at exiting 3 markets, Hungary, Czech Republic, and Slovakia. We're exploring that at the moment. These are essentially investment markets only. And we're also looking at adding some back book on top of that. And as an assumption for our trajectory, as a basis, we've assumed proceeds of around about 6 billion and a sale at round about book value. So when I combine all of this, what does that get us to? It's profitable growth in servicing, value extraction in investing to de-risk and deleverage. Now you're going to ask me, what does that mean in terms of numbers? I'll get there. I'll start with investing. So you've heard 10% CAGR. Servicing. 10% CAGR. We go from 10.6 billion to 15 billion. That's a contrast to what we've done in the past. In the past, we've delivered about 4%. If I strip out FX, it's around about 3%. So what is different? Well, we have a head of servicing, and we're really focusing on that business, and we don't have the alternative to deploy cheap capital into assets. So it's really a question of focus, and we have the right foundation and the right tools and elements outlined by George to really deliver that trajectory. Now, obviously, we want to have profitable growth, which takes me to the margin. And there we want to go from around about 18% EBIT adjusted margin for the total servicing business to more than 25%. Now, this is a new metric, and we're going to talk more about this and introduce it also in the context of our updated disclosure, which we're going to bring with later this year with the Q3 release. But to just give you a sense of what goes into this and how we've constructed this for transparency, is we take all the revenues in servicing, so external and internal revenues, and we deduct all the relevant costs, which is to say the direct costs, the indirect costs, and the overheads that are related to servicing. And that gives us a true underlying view on the profitability of that business. And we want to increase that by more than 7 percentage points based on the actions that Annette has outlined, and obviously the commercial focus and targets that George is setting in his area. In absolute numbers, that means our servicing adjusted EBIT goes to around about 2.4 billion today to more than 4 billion at the end of 2026. And that, if you look at the CAGRs between revenues and EBIT, really highlights the operating leverage that we're working on unlocking. Very different story for investing. So in investing, just to recall what I just said, we're extracting value, which means that from a P&L perspective, we really have a shrinking base, which means cash revenues go down to around about 10 billion, investing cash EBITDA goes down to around about 8 billion, and we have limited capital invested around about 2 billion per annum. But what's not on the page, but what comes out in aggregate when we look at the balance sheet, this is really unlocking cash. It's generating very significant amount of cash that we can direct to deleveraging. So what happens when we put these two businesses together and look at the group as a whole? Well, we have one business, servicing, that's growing. We have a second business, investing, that's shrinking. We put it together, we have a relatively stable trajectory going forward. So in terms of revenues and in terms of EBITDA, I would expect them to be relatively flat over the coming 3 years. But I think there's two very important facts in this page. And for me, they are that when we look at the revenues, and implicitly then also the earnings, the quality of those changes. And it changes because, as of today, the contribution from servicing is around about 43%. In 2026, based on this trajectory, it will be 60%. So in terms of having a higher contribution from a high value, recurring, fee-based revenue stream, we go from a very more investment-focused model to a very much servicing-led and focused model. And on top of that, that's the second element that's very important on this page, we generate 16 billion SEK, or more than 16 billion SEK, of discretionary cash. Discretionary cash is cash that we can use to reduce debt. Now, what does this 16 billion include? It includes what we generate out of our operations. It's net of expected taxes. It's net of expected interest, but it does not include the proceeds from selling some of our back book. And that takes me to the next page, because there we bring it together in terms of the balance sheet, in terms of what this means for de-risking and deleveraging. And top of the page, first chart is net debt. I would call that an absolute measure of risk. And we take that from just under 60 billion to around about 40 billion by the end of 2026. And that shows how we use that cash generation to really bring that absolute level of leverage down. Now, in terms of the leverage ratio, we're bringing absolute leverage down, but we're also growing our servicing business, growing the profitability of our servicing business, which means that we have a gradual, sustained deleveraging trajectory. And we go to around 4 times by the end of 2024, to 3.5 by 2025, and to less than 3.5 by the end of 2026. Same time, we obviously bring the book value of our investments down. Now, what I haven't put on this page, but what's implied in our action, is that obviously changes our funding and liquidity needs quite substantially. So where in the past, I would say on average, we had a funding need of around about €1 billion or more per annum. Because of this, going forward, that decreases to around about 500 million euros or less. Having said that, and Andres mentioned it before, if we direct everything against our upcoming maturities, we do not have to go to market. We can cover the maturities out to the end of 2025. It's not our base case, but we can do it if we choose to do so. Now, in terms of the financial trajectory, it's really, as I said before, grow servicing, it's extract value, generate cash, and it's de-risk and deleverage. And in a way, because I'm the CFO, when I talk about what are the upsides to this, I also have to talk about what are the risks, right? Start with the upsides though. One upside is asset management. So successfully executing the pivot to asset management that Andres and Javier have talked about, that would imply that we invest more in aggregate, but less from our own balance sheet, significantly less that we've invested in the past. So we grow the overall pool of assets that we service, which means it helps to boost our external servicing revenues growth further. And it also generates additional fee income, as Javier and Andres have illustrated. That's not included in the baseline trajectory. That's an upside, and we'll talk more about it when we're in place and can give you an informed view. Another upside is our investment in technology. So here we have included the costs, but we've only included very limited benefits. And as we execute and everything that Annette has laid out, I believe there is more potential. But we need to get everything on board, we need to execute, and we need to unlock it over time. Another upside, financing costs. So in our refinancings that we've assumed for this trajectory, we've assumed current market rates. Obviously, we would hope that as we de-risk and delever, that's recognized, and then that could create a further upside. Back book disposals, we've assumed we lose the servicing, but obviously retaining any servicing, which I would think likely would give us a small upside as well. Now moving over to risk. I think environment and regulation, we've not assumed any materially adverse changes, and we've assumed an FX rate that's consistent with the rates observed at the end of June of this year. And that takes me to execution. And execution is important. It's really about getting our head down, putting our head down, delivering on what Annette, on what George, and what Javier have laid out. Because at the end of the day, we have the foundation, we have all the ingredients, but it's up to us to actually, step by step, working on this day by day, deliver on it, and then translate it into the financial trajectory, as I've just talked about. And financial trajectory is, I think, is a good buzzword to take me to my final slide, which is our financial targets. So going back to what I said before, we have a business that's growing, servicing, and we have a business that's shrinking, investing. And we need to reflect that into our financial targets. So if I start with servicing, I think the mantra there is really profitable growth. And that's what's reflected in our targets. Growth, growing external servicing revenues with a 10% CAGR, so going from 10.6 billion at present to around about 15 billion by the end of 2026, is really based on executing on commercial excellence. It's based on what George has talked about. In terms of doing that profitably, profitable growth, it's really based on expanding that margin, on implementing the measures that Annette has talked about, implementing the performance and profitability management that George has talked about. So we want to take that margin from around about 18% today to more than 25% at the end of 2026. That takes us to investing. And there, as I said, it's about value extraction. And value extraction, a proxy for that is balance sheet intensity. So we want to take the book value of investing, of our investment portfolio, from currently 41 billion to around about 30 billion. And that then comes together in the de-risking and deleveraging part of our priorities. So our leverage ratio target is 3.5 times by the end of 2025. And that would then also be a catalyst to resuming payment of dividends. Now, if I had to put all of what I've just said into one sentence, then it's really that our priorities are to profitably grow servicing, extract value from investing, and to de-risk and delever. And I think with that, I want to hand it over to Andres for some concluding remarks.